If you're a creative professional struggling to get a handle on your finances, then you're not alone, especially if you own and run a creative agency. But don't worry, because in this episode, I'm laying out the 3 stages of financial management that every creative agency should master. Welcome to the JWellsCFO show. I'm Jeremy Wells, CPA, and owner of JWellsCFO, an advisory firm helping creative agencies and their owners. So let's face it, they say money can't buy happiness. And whether you agree with that statement or not, you have to admit that it sure does make running business a whole lot easier to have money. So as a business owner, you have to understand how money works. So let's look at the ins and outs of financial management for creative agencies. So what do I mean by financial management? I mean applying the financial resources of your business to achieve your personal vision. So I'm not strictly talking about managing the finances within your business. That's the accounting and finance function within your agency. What I'm talking about is connecting the financial performance of your business with your personal financial and lifestyle goals and vision. Your vision is the goal here. It's the North Star. It's what I'm interested in helping you achieve. Building a successful, profitable, sellable business is great, but the reason we're doing that is to achieve some bigger purpose, some bigger vision. It's not the end itself to build a successful business. That business is a means to an end. Without that personal vision, you don't have the clarity or the focus you need to make big decisions for your company. To be the best leader of your company you can be, you have to be focused on your personal vision, and you've got to be clear on what that vision is. It can't just be more money for the sake of more money. It can't just be a bigger business for the sake of a bigger business. There has to be some result, some lifestyle, some goal, some vision you're working toward. And then we can begin to figure out how to use the business as a tool in your personal financial toolbox to help you achieve that vision. You can run a profitable, successful company without a compelling vision, but it will never achieve an optimal state without one. There are 3 levels of financial management when it comes to building your business as a tool in your personal financial toolbox, as a means toward achieving your personal financial vision. The first level is cash flow, the second is profitability, and the third is wealth. You can think of these as a pyramid, with cash flow as the base, profit as the middle layer, and wealth as the pinnacle or the top of that pyramid. You have to have the base, cash flow, in place first, then focus on profitability, and once you've achieved that level, you can start to think about building wealth, the pinnacle of financial management. So I'm going to walk through these 3 different levels in order, starting with cash flow, then profitability, then wealth, and talk about what I mean at each of those levels, how I'm defining them, what's included, and how your business is functioning and what you're focusing on when it comes to running your business at each of those levels. The first level, or the base of the pyramid, is cash flow. So what do I mean by cash flow? Cash flow is the difference between incoming cash flows and outgoing cash flows over a particular period of time. Your business is like an engine. It's the engine of your personal financial vehicle. An engine needs to bring in fuel, cash, and it needs to put out energy or drive. So the fuel coming in is the cash flow coming into the business. And usually that is coming from payments that you collect from customers, or it could be coming from other sources, such as money that you or other investors put into the business. Maybe it's cash coming in from loans or a line of credit, but that cash coming in is what fuels the engine. Then that engine needs to put out some sort of product. It needs to put out either energy or drive, and that comes in the form of external cash flow. That is going to be what you use to pay yourself or to reinvest back into the business to make that engine grow and become even more powerful, or it's what helps you build up toward your financial vision. So cash flow is the difference between incoming cash and outgoing cash. Another way to think of it is deposits minus expenditures. Now, deposits means every time cash comes into the business bank account, regardless of the source. And expenditures are every time cash goes out of the business, regardless of the target, regardless of whether you're getting that cash or a creditor or a vendor, doesn't matter. Deposits minus expenditures. All the cash coming in minus all the cash going out. Over a particular period of time. That's important as well. So often we're looking at cash flow from a monthly perspective, maybe a quarterly perspective, and an annual perspective. What's the total amount of cash that comes in during that month or quarter or year minus the total amount of cash going out? We want that number to be positive. If that number is negative, then we're running into problems. But overall, we want that number to be positive. A business without cash can't pay its bills, it can't invest in growth, and it certainly can't pay its employees. And you are employee number one. Whether you're actually on payroll as an employee, you are employee number one of your business until we get to the pinnacle of the financial management pyramid, where you're no longer a day-to-day employee of the business. But hopefully you're still getting some sort of return even after you have left the business, resigned out of it, or retired from it, or even sold it. Hopefully there's still some return coming to you. So ultimately, the business has to have cash. And the way it gets cash is by having and maintaining positive cash flow. Cash flow is like blood flow. A living creature can't survive without healthy blood flow. If it's losing blood or the blood isn't flowing enough to the vital organs, then that living creature will not survive. And similarly, a business cannot survive without healthy cash flow. So how do we manage cash flow and make sure that your business can survive? There are a few different ways at the outset and really throughout the life of a business that are basic ways we're looking at to make sure that we're maintaining positive cash flow. The first is setting up and maintaining an accounting system for tracking revenue and expenses. Now, revenue and expenses are different from deposits and expenditures. And this is a little bit more advanced, something that I can talk about in a future podcast episode. But most of the deposits for your business, once it's up and running, should be coming from revenue. And most of the expenditures of the business or outgoing cash should be going to pay its expenses. You might have some debt payments, you might have some distributions to owners and investors, but the majority of the financial activity going on in your business once it's up and running should be coming from revenue, creating deposits of cash, and expenses, creating expenditures of cash, and then you're looking for a net positive cash flow. So we want to make sure that we have a system in place that is accurately tracking all of the revenue and expenses along with deposits and expenditures. And a big part of the accounting function is to reconcile those different numbers. Are we actually collecting deposits for all the revenue we should be? Are we actually making sure that all of the bills are getting paid so that the expenditures match the expenses? We're also going to want to look at negotiating favorable payment terms with your customers so that you're getting paid on time, if not upfront. My goal in my business and with my customers' businesses is that you're getting paid upfront. There are some situations where you might need to invoice after the fact, but ideally I'm always looking to be paid upfront if possible. And then we also need to try to negotiate favorable payment terms with your vendors, your suppliers, the contractors that you hire, the outside services you use. If you can delay payment as much as possible to them when cash flow is tight, that could be to your advantage. Or there might be circumstances where we want to pay early or even prepay. Perhaps there might be an opportunity to get some discounts or to accelerate the deductible expense into the current year rather than waiting till next year. There could be several different reasons why we would want to adjust the timing of when we're collecting payments from our customers and when we're making payments to our vendors. We also want to make sure that we're keeping your tax liability in check. So you need to be looking at your tax liability. You need to have a projection of your tax liability. Either you need to have a way of estimating that, or you need to be working with a tax advisor who can give you a projection of your tax liability. The number one reason you want to do that is so that you can make sure that you have enough cash on hand to pay that tax bill. One way you can do that is usually recommended is that you're making estimated tax payments throughout the year. The IRS and most states want you to make 4 estimated payments roughly quarterly throughout the year so that you're staying on top of your tax bill. Some states are a little different. And for some people, and in some situations, it might make sense to hold off on making those estimated payments. But generally, we want to at least make sure you have an idea, a projection of what your tax bill will be, giving you the opportunity to set aside the cash to pay that tax bill when it's due, if not actually make the payment. Otherwise, you're going to run into late payment penalties and interest, and the bill will go up and up and up. And you want to try to avoid that as much as possible. We're also going to determine your market pay. This is critical as a business owner, and most business owners don't do a good job of this. You need to have an idea of what your market pay should be. You also need to have an idea of what your reasonable compensation should be if you have a tax structure such as an S corporation or a C corporation for your business. But these are two separate concepts. Market pay and reasonable compensation are two different concepts, but they're both critical. Market pay is what you should be earning if you were doing a similar job for another company out on the open market. Reasonable compensation is what you should be paying yourself through payroll, and therefore the amount that should be subject to payroll tax as an employee of your business. Note that these are similar, but they're different in important ways. Now, you can only pay yourself one salary, so we're going to try to find a point that meets both of those criteria, but we've got to have a way of figuring out what those amounts should be. But it's important that you, as an owner-employee of your business, are paying yourself a market salary and reasonable compensation depending on the tax structure of your business. Now, that's a lot for most business owners to try to come up with. Your tax liability, your market pay, your reasonable compensation, negotiating payment terms with customers and vendors, and then setting up and running an accounting system. That's why my firm, JWellsCFO, offers a core accounting plan and also an advanced accounting plan to help you cover these cash flow concerns. The core accounting plan helps set up and maintain your accounting system using QuickBooks Online, which provides you with accurate, up-to-date financial reports. This way you can manage your cash flow. You know where your cash is coming in from, where it's going out to. And from that, you can begin to estimate your upcoming cash flow needs. We'll also run payroll for you, which includes running your payroll as an owner-employee, and that means helping determine your market pay and your reasonable compensation. And then we'll file your tax returns and we'll help you calculate your estimated tax payments. So these help address your cash flow needs. We help both your business and you stay on top of your business's cash flow needs by having those financial reports available, which shows you the trends, the cash flow trends in your business, where the cash is coming from, where it will need to go. We'll also help you run payroll, which for most creative agencies and service-based businesses is going to be your number one expense, will be payroll, will be labor. So you'll definitely want help staying on top of that. And then making sure that you've set aside cash personally for your tax liability and making sure that those tax returns are prepared well and that they're filed on time. The advanced accounting plan also includes managing your accounts receivable, which is your invoices and your payments collection. So making sure that you're sending invoices correctly and that you're getting paid on time by your customers. And then also we'll manage your accounts payable. That's your bill pay. That's making sure that all of your vendors and contractors are getting paid on time in the most favorable way to you, and making sure that they're staying happy so they want to continue working with you. So those are the ways that my firm can help you with your cash flow. And once you have properly managed and optimized your cash flow situation in your business, that gives you a solid base to operate from. The next step, or the next level in the financial management pyramid, is profitability. Now, most business owners are worried about profit, and they tend to look at profit first. In fact, we have a financial statement that a lot of business owners look at, and they pull from their accounting software, such as QuickBooks Online, called the profit and loss statement. And they want to know if their business is profitable. But notice that profit is the second level in my pyramid here. The first level is cash flow, because profit does not pay bills. Profit does not pay employees. Profit does not pay off loans. When you need to go pay bills, when you need to buy groceries for yourself, profit won't help you. Cash is what you need. So we need to make sure that there's adequate and healthy cash flow first. Once we have cash flow optimized, then we can start focusing on profit. So what is profitability then if it's not cash flow? Profit is a measure of how much money a business is making after all of its costs have been taken into account and all of its revenues have been accounted for. So it's a measure of the long-term sustainability and success of the business. Notice before that I said cash flow was deposits minus expenditures, cash inflows minus cash outflows. Profit is revenue minus expenses. These are different concepts. Not all cash inflows are from revenue or sales. Not all cash outflows are from expenses or payments to vendors and contractors. A business that doesn't make a profit can survive on owner contributions and credit for a while. And so that's why it's important to distinguish between revenue and cash inflows. Your business might be able to come up with cash to get through a pinch without making additional sales. Maybe your business brings on an investor. Maybe you establish a line of credit with a bank. That gives you access to cash to pay bills, to pay down debt, without actually making a sale. Now, you can do that and get away with that for a while, but eventually, either that new investor is going to want a return, or that line of credit will need to get paid, and you'll be right back to where you started, if not worse off. So we need to make sure that the business is profitable, because even though profit can't pay bills, what profit does is it supplies positive cash flow into the business. So a business that doesn't make a profit can survive on owner contributions and investors and credit for a while, but eventually it needs positive cash flow fueled by profit. This is different from cash flow, like I said, which is the movement of cash in and out of the business, and refers to the inflows and outflows of the deposits and expenditures of cash over a given period of time. Profitability, we're looking at revenue minus expenses over a period of time. Now, for some examples of how cash flow and profit might differ, we can look at some specific types of transactions. So if you have already mentioned, for example, owner investments or contributions into the business, that's cash inflow that isn't affecting profit. And then draws or distributions of cash out of the business, that also does not affect profit. Loans and lines of credit supply the business with cash, but they don't affect profitability. At least not directly. Now, eventually those loans and lines of credit will need to get paid off, and that means interest expense. So the interest expense will reduce profitability, but the actual incoming cash and then the cash that goes toward paying off the principal of those loans and lines of credit, those transactions don't affect profitability. And then purchasing assets doesn't affect profitability, at least not initially. So if your business buys a $5,000 piece of machinery or a $50,000 vehicle to make deliveries, those transactions, at least initially, will not affect profitability. Now, we will depreciate those assets, and that will create depreciation expense, which will affect profitability eventually, but the initial purchase of those assets will not affect profitability. On the flip side, there are transactions that will affect profitability, but not cash. So, for example, invoicing. On an accrual-based accounting method, and this is advanced accounting that you don't necessarily need to understand or worry about right now. But if you're looking at accrual basis financials, you will see revenue that reflects invoices sent to customers that may not have yet been paid. So there hasn't been any cash payment made on those invoices, yet once we send the invoice to the customer on an accrual basis, we're already considering that amount as revenue, even though it hasn't been paid yet. Now, on cash basis financials, we're not counting the revenue until we've actually collected the payment. This is a big difference between cash and accrual. It's one of the reasons that a lot of businesses should be using accrual instead, because it gives us a more accurate reflection of what revenues will be, even though the cash hasn't been collected yet. If I look at a P&L that's cash basis today, I'm seeing cash that has been collected. But if I'm looking at a P&L that is accrual basis, I'm looking at revenue that should be collected, whether we've actually collected that payment or not, because the check might be in the mail. The customer might be getting ready to pay that invoice. So it may not be income in terms of a cash inflow today, but it will be tomorrow. And so the accrual basis says that we should be considering that revenue even though we haven't collected the cash payment yet. Now, this is something that you can work with your CFO or controller to understand and to think about how this matters for your own business, but it's an example of an accounting transaction that affects profitability but doesn't affect cash. Purchasing items on credit will affect your profitability because you're going to expense the supplies that you purchased on credit, or maybe you signed up for some new software or bought some tools on credit. So you're recording the expense, thereby reducing profitability, but no cash has been paid yet because you swiped a credit card. So your cash flow hasn't been affected yet. There hasn't been an expenditure, even though there's been an expense. Now, when you turn around and pay off that credit card or make a payment toward that credit card, you will have already recorded the expense. So the credit card payment is not an expense, even though it is an expenditure. It's a cash outflow. And then another example of a transaction that will affect profitability but not cash is equity compensation. If you compensate an employee with equity in your company, that is considered part of that employee's compensation. It is part of their pay. It's going to be reported on that employee's W-2. And it's part of your salaries and wages expense. So it will reduce profit, even though there's no cash outlay. You're not paying cash to that individual. You're granting them the right to equity in your company. Now, that grant of equity sometimes is subject to payroll tax, for example, so you might have a little bit of a cash outlay on the tax side of things, but the actual equity compensation itself is not a cash transaction, even though it will affect profitability. So you can have a profitable company that struggles with cash flow because there might be high debt and therefore lots of cash payments to pay off that debt. Or you might have excessive distributions to the owners. You might have owners that take more cash out of the business than they should, which puts the business into a cash flow crunch, even though it's a profitable business. This gets a lot of business owners in trouble because they look at the bank balance and they don't see much cash there. But then come tax time, they have relatively high profits and they can't understand why they have such a high tax bill when there's almost no cash in the bank. And it's because they've been taking that cash out all year long and not setting any of it aside for taxes. So you have to balance the profitability of your business with your draws on the cash of that business. You can also have low or no profit, but relatively substantial cash reserves from debt or equity. So if your business is early and maybe doesn't have much activity yet, but you have put some substantial money into the business bank account to cover expenses, your business might actually be running at a loss, even though there's plenty of cash in the bank. So you want a balance, and ideally healthy cash flow and profit, both. So we need to make sure that there's plenty of cash and that there's healthy cash flow to sustain the business's operations and to be able to afford your market-based pay as an owner-employee first. That's our first priority. Then we also need to make sure that the business is profitable. And once the business both has healthy cash flow and is profitable, we want to make sure we achieve and maintain a balance between those two. So profitability becomes the focus once a company secures minimal cash flow to cover expenditures, not expenses, but expenditures, cash outlays, because we're including payments to debt principal and distributions to owners here. So we need cash flow to cover expenditures and compensate owners. My Profit Partner program that I offer through JWellsCFO includes tracking and reviewing key performance indicators, or KPIs, and comparing those to industry benchmarks. So the question here is, how profitable is your business in relation to the rest of your industry? Are you as profitable as your colleagues and competitors? Are we optimizing gross and net profit margins? There are ideas about the ratio, the ideal ratios between revenue and gross profit and revenue and net profit. Now, I have another podcast episode where I talk about profitability and how we measure and think about profitability. So if you haven't listened to that episode, go listen to that one. But in terms of measuring profitability, we want to make sure that you're optimizing your gross and net profit margins. We also want to look at improving business processes and standard operating procedures, and that's going to factor heavily into your profit margins as well. We also want to do some short-term tax planning. So in the cash flow level, the base level of the financial management pyramid, we are focused on helping you estimate and project your tax liability and make estimated payments toward that. Here at the profit level, because as profit increases, so will your tax bill, and that's a good thing. Your tax bill will increase because you're showing a more profitable business. That's a good thing. It's a good thing to have a more profitable business. Therefore, it's a good thing to be paying more taxes. But we still want to make sure you're not paying more taxes than you have to be. So we want to make sure that you've optimized your short-term tax situation. So the Profit Partner Program includes setting up a business dashboard with industry benchmarking and making sure that you have a good idea of how your business is running and how it compares to those in your industry. So this is a step up from just receiving monthly financial reports out of your accounting system. This takes your financial data from your business to the next level by using those data to analyze how your business is performing and especially how it's performing relative to your industry. We're also going to have monthly calls to review that dashboard and to go over those numbers. So at least 10 times a year, we take a couple months off. We take a month off during the summer for vacation usually and a month off in December for the holidays. But at least 10 times a year, we are going to sit down together, usually on a video call, and actually review that dashboard and look over those KPIs and those industry benchmarks and start thinking about ways that we can improve or at least maintain those numbers that we're liking or improve the ones that we're not liking. We're also going to have a quarterly accounting review, and this is something that I specifically am going to do. So this Profit Partner Program works great even if I'm not your accountant, even if my firm isn't doing your accounting work. The Profit Partner Program works great for you in that case because this gives you a second set of eyes and a well-trained and well-versed set of eyes looking over your books once every quarter, and making sure that there are no glaring errors, that there are no red flags, that things are categorized correctly, that your bookkeeper is doing a good job. So if you've got an outsourced bookkeeper or an in-house controller, you may not have a good idea of whether that person is correctly categorizing all your transactions, whether that person is following generally accepted accounting principles or what we call GAAP. Now, there's formal GAAP that big Fortune 500 companies are supposed to follow, and then there's just sort of everyday small business, generally accepted accounting principles. And that's what I follow in my own business, in my own firm, and what I use for my customers. And that's what I'm going to apply to your agency's books, making sure that your bookkeeper is correctly categorizing, especially big transactions, especially important transactions, and making sure that your books make sense. There might also be some stylistic issues. Your bookkeeper might be doing things correctly, but the financial reports are organized in a way that aren't intuitive for you, or that don't make sense, or aren't actually showing you and giving you the insights about your business that you really need and that I need to be able to help advise you on running your agency. So that's something else that we might agree on as part of the Profit Partner Program is ways that your bookkeeper can reorganize your financial statements or your chart of accounts so that you get a better idea of how your business is performing. And then we're also going to have an annual tax planning meeting. So this goes beyond just projecting your tax bill. This is looking at potential strategies that you could put in place, both in your business and in your personal finance, to optimize your tax bill. And again, this is going to work whether I prepare your tax returns or not. As long as I have access to your previously filed tax returns and to your business finances, as well as some other information. So for example, if you have a spouse that earns an income and you file jointly, or if there were any events that happened in the year that might change your tax situation, such as you got married, or you got divorced, or you had a child, or you moved to a different state, all of those kinds of things we can update on as part of getting ready for this meeting. And then during this meeting, we can go over
some tax strategies that might be available to you either that year or in the upcoming year. During those dashboard review calls specifically, we'll discuss some various factors that affect profitability, since this is the profitability level of the financial management pyramid that you're at. We're going to look at pricing strategy. Pricing is directly going to affect revenue. And although revenue is not a KPI that I track, it is a significant part of calculating the KPIs that I do track, such as gross profit margin. So if your gross profit margins need improving, we're going to look at ways to increase revenue. And one way that we can do that is by looking at your pricing strategy. Maybe getting you off of time-based billing and looking at project-based billing, or ideally either fixed price or subscription model. So we might look at different ways that you can price what you're doing as a way of boosting revenue without significantly needing to overhaul how your business is running. Or we might come up with a new pricing strategy that does change the nature of your business model. For example, shifting from time-based billing toward a either value pricing or subscription model, that is a business model change. That will have downstream effects that affect your capacity planning, that affect potentially how you are selling and labeling your services. So we might start getting into some decisions that have business model implications by specifically focusing on pricing strategy. We're also going to be looking at spending strategy, making sure that the things your business is spending money on actually make sense. And we're going to be looking at industry and market conditions. Again, we're comparing your company with industry benchmarks. So we're going to be taking into account industry and market conditions as part of reviewing that KPI dashboard. This takes the first steps toward crafting a solid business model that helps you build a profitable, sellable company, which is the key to the pinnacle of the financial management pyramid, wealth. There's a big misconception. Income does not equal wealth. If I want to know how wealthy you are, telling me how much money you make does not answer that question. Income is a tool to build wealth. It's good to make money. It's good to have income. And the more income you have, the quicker you will be able to build wealth, as long as you manage that income and your expenses well. But it's possible to have a lot of income, but also spend a lot of money and therefore never become wealthy. So income is a tool to build wealth, but it is not wealth. Wealth is the total value of your financial and non-financial assets. From a purely number standpoint, wealth is the total value of your financial and non-financial assets, such as cash, investments, real estate, your personal possessions. And as a business owner, your company is likely one of the most, if not the most, valuable assets you own. Now, eventually, maybe your retirement plan will be worth a lot. Maybe your home will be worth a lot. But even then, for most business owners who truly are focused and committed to building a great, sellable, valuable business, the business winds up being their number one asset in terms of monetary value. So to maximize your wealth, you have to build a valuable, sellable business. And that is what the pinnacle of the financial management pyramid is all about as a creative agency owner, helping you build a valuable, sellable business. So what makes a business valuable and sellable? And this is something that I'm going to talk about a lot more in future podcast episodes, but ultimately it comes down to two things. A consistent demonstrated return in terms of profitability and cash flow, meaning you are showing that periodically, monthly, quarterly, annually, your business has consistent demonstrated returns in terms of both profitability and cash flow. That your business isn't struggling for cash, that your business is profitable, that you're not spending too much on expenses to try to reduce profit to chase some short-term tax savings, but that also your business is not struggling with cash flow because you're taking too much cash out of the business to pay for your expensive personal lifestyle. We're showing a healthy balance between both cash flow and profitability, and ideally that those numbers are growing over time so that you are consistently demonstrating returns. That's what is going to make your business valuable. That's what is going to make an outside investor or potentially a buyer or someone in acquisitions or a competitor's business that's looking to acquire your business or merge with it. That's what's going to make them look at it as a valuable business, is that you have consistent returns in terms of profitability and cash flow. That, and the second thing that's going to make for a valuable and sellable business, which is a clear exit strategy. And that clear exit strategy is going to consist of a plan to put people and capable people in charge of the critical business functions of the company so that it doesn't depend on you to operate. If the business depends solely on you to operate well, then that is going to severely limit both its value and its sellability. Now, in order to have other people in charge, you're going to need well-documented standard operating procedures, and you're also going to have capable staff. If you can put people and processes in place and show that the business is profitable and positively cash flowing over time, you have a valuable, sellable business. And that is what we're working toward really throughout the financial management pyramid. But at the top level, at the pinnacle of that pyramid, that's our goal. That's what we're trying to do. We're trying to show the market, show your colleagues and competitors that you have a valuable, sellable business. And that's what my fractional CFO program in JWellsCFO does. My fractional CFO program helps owners scale profitable and sellable businesses, which is going to help you build personal wealth. And it's going to help you leave a lasting legacy. You are not going to work yourself to the point at which you either can no longer work and therefore have to quit your business or sell at a relatively low multiple. You're going to build a business that scales, that is valuable and sellable, that is going to become a true source of personal wealth. And that's also going to leave a lasting legacy, both in terms of your family and in terms of the marketplace. So there are two key components here in my fractional CFO program. The first is an annual financial roadmap and a review of your company's revenue, spend, and people strategies. So we're going to dig even further than the Profit Partner program. We're going to really dig into your business's finances, into its KPIs, and then we're going to turn that into forward-looking forecasts and budgets. We're going to be looking not just at how your business has performed, but we're going to be looking at how we want it to perform and how we think it's going to perform in the future. And so we're going to be talking about how to make decisions that get your business where you want it to be. Not just how your decisions have panned out so far, but the decisions you need to be making to get the business to where you want it to be. And we're also going to craft a written exit strategy so that your company knows exactly how it can continue to prosper without your day-to-day involvement. That's critical because you need to know that your business can operate without you as well. And this is not just about your retirement. This is also about your personal well-being. It's entirely possible that something catastrophic happens to you tomorrow Something catastrophic could happen to you right this moment as you're listening to this podcast. And what would that mean for your business? What would that mean for your investors? What would that mean for your family? What would that mean for the people who rely on you and your income? You need a plan in place that not only accounts for how your company is going to provide you with wealth, but you also need a plan in place that's going to provide for your company should you, for some reason, whatever reason, no longer be able to run your business. So we're going to make sure that is in place, and then we're going to start making decisions that work your business to the point at which it does not rely on you day to day. So we're going to figure out the procedures and processes that need to be in place so that you can begin hiring for key functional roles to get you out of sales, to get you out of marketing, to get you out of operations, fulfillment, administration, finance. We need to get you out of those critical functions, get capable people in who are following procedures and processes that you've put into place so that the business can begin to operate without you. And you can always stay in charge. You can always be the CEO unless you don't want to be the CEO or unless you find someone who would be a better CEO than you. Lots of founders are great founders, but not necessarily good CEOs. And that's a reality that a lot of business owners have to face as their business grows. So we can get you out of being president, meaning in charge of day-to-day operations, and transition you into being CEO, meaning now you're the visionary, right? You may not be directly involved in day-to-day, but you're still leading the company. And ultimately, we want to get you to the point to where you're chairman of your company, meaning that you're still overseeing how the company is performing. You're still overseeing who gets to run the company, but you're not responsible for either the day-to-day operations or even the leadership of the company, at least not directly. That's the ultimate goal. We want you to be in a position to where you still have some oversight of the company, but you're not worried about the day-to-day operations of the company. You're not even worried about the actual leadership of the company because you have capable people following processes and procedures that you put in place so that the company can exist and run without you. And that is when you are able to most effectively tap into the wealth that you have built by means of building a successful, profitable company. Because now that company is either ready to sell or is ready to have you as a passive investor that is still rewarding you with profits for having created and run and managed and built a successful company. But now you can give yourself a break from having to run the day-to-day operations. That's the goal. That's what we're trying to get to. That's the North Star when you work with me, when you work with my firm, JWellsCFO, in running your agency. And that's what the Fractional CFO program is all about. It's all about getting you to that point. And again, just like the Profit Partner program, that is available whether my firm does your accounting or not. I don't need to be your tax preparer. I don't need to be your bookkeeper in order to be your CFO. Now, you need to have people in place doing those things and doing them well. And if you don't have people doing those well, then I can help refer you to people who will help you. So we're going to make sure that your tax, accounting, legal, insurance, finance, all of those core competencies, that you have people in place that you can rely on, that you have advisors that you can rely on. But at the end of the day, you know that you have a CFO that can help advise you on these matters and can help find referrals for specific advisors in these certain functions and areas. So, your financial management pyramid, the first layer, the base, is cash flow. We want to make sure that you've got the cash flow taken care of, that you have positive cash flow coming into your business so that you can sustain operations and that you can afford to pay yourself. Then we're going to focus on profitability. That's the middle layer. Profitability is going to be the first steps toward making your business not just viable, but valuable. And then the pinnacle is wealth. Once you have that business that is operating from standard operating procedures and from having a capable team in place so that it's no longer dependent on you day to day, that is when you are now positioned and primed for wealth and for achieving that vision that you have had and we've been working toward all along. So tune into future episodes. Be sure to subscribe to this podcast if you haven't already, because I'm going to go more in depth into all of the things that I've talked about in this episode. This episode really lays out the way I'm thinking about helping customers of mine moving forward. JWellsCFO has been a primarily tax and accounting firm with a little bit of advisory for its customers, but customers today, the ones that are looking to build profitable, sellable businesses, they need more. And I am changing things in my firm, and I'm offering new ways of working with me and my firm so that you get exactly what you need. If you're at the beginning stages, then you need to make sure cash flow is covered. And so that's where the core accounting plan and the advanced accounting plans come in. If you're at the next stage where profitability is your goal, then we need to have a dashboard with KPIs in place, and you need to start doing some tax planning because you're going to be paying taxes on that new profit, which is a good thing. But ultimately, your goal is wealth. And so the Fractional CFO program is what's going to put you in the driver's seat of a valuable, sellable business so that you can begin working your way towards your personal financial goals and out of the day-to-day work of running your business. I'm Jeremy Wells of JWellsCFO. Thanks for listening. Have a good one.